What's up, everybody? Joe Brown here. This is the Heresy Financial Show, and today the wholesale inflation numbers came out and they rose at 11% year over year. Not only is this a problem because wholesale inflation or producer price inflation is a leading indicator for consumer price inflation, but it's also a problem because this could potentially lead to mass layoffs and the strong labor market could turn on a dime, and we are already starting to see signs of that coming. Ready? Let's dive in. So take a look with me here at this article from CNBC. Wholesale inflation rose 11% in April. So that was 11% year over year, but it was 0.5% in April alone, month over month. So as a refresher, what is producer price inflation or wholesale inflation? If we take a look at the U.S. Bureau of Labor Statistics, the BLS website, the PPI records the first commercial transactions for many products and some services. It is also just looking at domestic producers. So both CPI and PPI are measures of inflation. Consumer price inflation, CPI, is trying to measure what the consumer pays, the average person, the average household, for the cost of living. PPI is looking at the prices of all those goods and services as they first start to hit the economy with companies, producers, the manufacturers, before they make their way to the end consumer. So the PPI measures the average change in sale prices for the entire domestic market of raw goods and services. These industries include mining, manufacturing, agriculture, and a whole host of other industries. Again, the raw goods and services before they make their way throughout the economy. And because they are focused on the output of U.S. producers, again, imports are excluded. This is just domestic. And then finally, PPI is a leading indicator for the CPI. This is because when producers have their prices increase, they are going to pass those price increases on to retailers and to consumers. And this longer term chart of PPI from Bloomberg shows we are at 11% for PPI, which shows that the strength in this growth curve is still on point. Now, it's important to remember, March numbers were revised up. So while it looks like we're experiencing a dip here, while prices for producers are still moving up but at a slower pace than last month, we could also see a revision upwards for the April numbers as well. So at this point, there are still no signs of inflation significantly slowing down. While the rate of growth of prices may have peaked, the inflation rate is likely sticking around. This is like if you're driving a car and you're accelerating from 0 to 75 miles an hour, and then you stop accelerating and you just keep on going at 75 miles an hour, you're still moving forward at 75 miles an hour. Even if you start to slam on the brakes, now you're going 65, 55, 45, and even if you come to a dead halt, now that would be like prices aren't moving. And so prices are still moving up. They may slow down in the rate that they're moving up, but prices will still be moving up until we experience deflation or a drop in prices. No sign of that coming anytime soon, though, especially given the heightened PPI that we are experiencing right now. So what's the problem with this? Well, number one, those prices are passed on to consumers in the future. But the real problem with this is unemployment. Now, we've heard for 2 years now about the extremely strong labor market. Many job openings. We've seen a rise in the labor force participation. The Federal Reserve keeps on saying, hey, we're going to fight inflation. We can do that because of the strong labor market. However, this can turn on a dime because for many companies, wages, employees are the number one cost. And so if you're a company that's getting squeezed and you're starting to lose money because you are buying things and you can't sell them at a profit, you're going to have to cut costs somehow. And many times that comes in the form of layoffs, especially if you're a company that has not been profitable historically. You're a company that's been relying on debt and investor funding. And now you're hitting a point where you realize the economy is slowing down, the free money train is running out, and you are not able to secure financing anymore. Your runway ends and you have to cut costs. And most of the time, the first place that starts is in layoffs. And the perfect example of this is today, the breaking news that Carvana has just laid off 12% of its workforce, and the kicker here is that most of them were fired through Zoom. On Tuesday, Carvana confirmed they laid off 2,500 employees, many of them over Zoom. They cited recent macroeconomic factors that have pushed automotive retail into recession, which is very interesting considering the fact that used car prices have beat every major investing index for the last year, maybe more. Now, for Carvana employees, it's not all terrible news, as the executives are apparently giving up their salaries for the rest of the year to help pay for the severance packages for the laid off employees. However, this is potentially a bad omen of the future, as labor conditions can turn on a dime, especially if costs continue to accelerate through the roof and retailers, businesses are not able to get in front of that. And as this turns around, just as we've seen a wage price spiral up where people start getting paid more so they can afford to maintain their standard of living, so they keep on buying the things that are in short demand, and that continues to drive the prices up. As we see that spiral can reverse on a dime, and as people start getting pay cuts or getting laid off, demand starts to drop, which means revenues for these companies start to drop, which means they have to start cutting costs even faster, and you can have this whole thing reverse on a dime very quickly and have these tight labor markets, these tight labor conditions turn around on a dime and mass unemployment spike. And the layoffs that Carvana is going through right now are not the only sign of weakening demand. If we take a look at this article from Bloomberg from a few days ago, stock traders starting to see hard landing in soft data. So they're looking at bad news with prices in a free fall. Equity investors have started to view a lot of data as evidence that the Fed is wrong when it says the economy is strong. Among them are mentions of weak demand in the earnings season, which rose to the highest since the second quarter of 2020. This means that in earnings reports that are coming out right now, we are seeing a spike, a recent record in the number of times in the frequency of the phrase weak demand coming out of these official statements. Another report showed traffic to stores flagging. Earnings may be up, but analysts are cutting profit estimates, and a few consumer-oriented companies have warned of delayed orders, which is behavior usually seen in downturns. So costs are skyrocketing, layoffs are starting, and analysts are starting to see companies all over the place cite weak demand. Just as the wage price spiral can push prices and numbers up, this can reverse on a dime and things can collapse in one moment's notice. And the worst part about this is, I mentioned this in my video yesterday, this is the express purpose of tightening conditions. This is the purpose of raising rates. This is the purpose of going to QT from QE. It is to cause a demand drop, because the demand spike, which is funded by all the free money, is what causes the inflation. So you need to stop demand, which means taking money out of the hands of the economy so that money becomes more valuable relative to all the stuff. That means prices drop. That means there's economic pain so that prices stop going up, prices start coming down. And the way you do that is with unemployment. Just as you cause higher inflation with higher wages and more employment, which is what the Federal Reserve has been attempting to do for the past 2.5 years, the opposite is true as well. You need to stimulate deflation or disinflation by causing unemployment and wage declines. So first, as Lagarde said a few years ago, yes, we took your savings, but at least you have a job, and now they're coming after your job. Again, this isn't a symptom. This is the express purpose of the tightening. And so then the question comes, what will policymakers decide to do when prices are still going up and unemployment starts to shoot through the roof? Because at that point, they have to choose between sacrificing the economy and sacrificing the dollar in the moment. It's not a future theoretical question at that point. The question is right now, we are either going to lose one or the other. What are policymakers going to choose? But as for now, I expect much more economic pain in the near future before we get to that point. As always, I really appreciate you guys. Thank you so much for watching. See you next time.